Welcome to part 2 of my Technical Analysis Foundation course, a guide to mastering candlestick charts. This lesson is brought to you guys by Femex. I'll talk more about them later in this video. Let's go over the content for this lesson. First, we're going to cover the basics of how to read candlestick charts and talk a bit about why we use them, the key principles of data analysis, a visualization technique, my own personal one, for memorizing pretty much every single chart pattern just by understanding what the data actually means. So I'm going to go over the usual disclaimers. This video is for entertainment purposes only. Any information spoken or written should not be interpreted as financial advice. Carry out your own independent verification of facts and data. Don't just take my word for anything. I am not a financial advisor. I do not hold any relevant qualifications. If you seek financial advice, speak to a professional. And finally, trading is an extremely risky activity. Your trades are your responsibility, so trade at your own risk. How to read candlestick charts. Let's start with the body. The body is simply this thick bit in the middle. There's going to be an open price and a close price. The distance between these two is the body. The open and close can switch positions depending on the color of the candle. Now in this example, I've used white and black. That's because that's what I use on my charts. Sometimes you'll see green and red, or any combination of colors which someone likes to use. For the duration of this course, I will be using white and black, and anyone following my tutorials will likely be doing the same. This is our bullish candle, where open, the price starts here and it closes up there. That means price has moved up. This is our bearish candle, where price opens there and closes there. It means it's gone down. Time. Each candle represents a specific interval of time. Now this could be anywhere from 1 minute to the 1 week. Could be the 15-minute, the 1 hour, or the 1 day. You're going to learn a bit more about exactly what that means later on. For now, if you don't understand, don't worry. Open and close price. This is going to explain the time intervals a bit more. The open price is the price at the start of a time interval. So say we take a 15-minute block of time. At 0 seconds, that is the open price. At 15 minutes, that is the close price. So if the price goes down, it will close lower than it opened. If it goes up, it will close higher than it opened. Lastly, I'm sure you've all noticed these two tails poking out of the candles. Now these are referred to as wicks, shadows, tails. I normally call them wicks. And what they represent is the high and the low of the given time interval which we are analyzing. Now they don't always exist. Why is that? Well, the open can be the same as the low, and the close can be the same as the high on a bullish candle, and on the bearish candle the other way around. So if it opens at the highest price, it makes it that time interval, then obviously there's not going to be a tail. Same with the close and vice versa on a bullish candle. Let's take a quick look at a candlestick chart to make sure everyone understands how to read them. White candle, black candle. One represents the price moving up, the other represents the price going down. Why? Because we have open over here, close price over there, open price over there, close price over there. Price has moved down during this time interval, price has moved up during this time interval. These shadows or wicks show how far the price has traveled. Here we can see the price has gone all the way up here, but then it's come all the way back down. Time frame is also important. Right now we're looking at the 1 day. If we go up here, we can see that we can swap the time frame to say 15-minute. Now we're looking at a much more zoomed in time frame. So each of these candles now represents 15 minutes of data rather than 24 hours of data. And again, this is the start of 15 minutes. This is the close. Start, close. So hopefully we all understand now how to read candlestick charts. Now that you know how to read candlestick charts, let's talk a bit about why. It's quite simple. A line chart, for example, only shows close prices and time. That's it. Whereas this candlestick chart, it shows the entire range of movement in each time interval. It shows the close and open price, and it gives it to us in a very easy to digest format. We can instantly look at this and get a much clearer picture of what's happening in the market than when we look at a line chart. Key principles of data analysis. Context. When you're analyzing this price data, context is essential. Always keep the big picture in mind. Data in isolation without context is entirely useless. Next, sample size. We're using limited data to try get an idea of the big picture. The more data we have, the more representative it is of the total population which we're trying to analyze. So sample size is very important. Next, quality. Now, quality of data. Remember, data always comes with noise. It's important to learn what's important and what isn't. Every time you're analyzing something, you carry out an experiment, there are going to be anomalies. We need to be able to identify these. Next, keep it simple. We're trying to build a framework in which we can consistently analyze the market. Simplicity makes consistency easy. Remember that, write that down. Simplicity makes consistency easy. Avoid overcomplication wherever possible, and you will become better traders, I can promise you that. Okay, so now that we have a better understanding of the key principles of data analysis, let's talk about specific timeframes. Well, what's the difference between a higher and lower time frame? Well, higher timeframes incorporate more data. They're going to have a larger sample size. Therefore, they're going to be less volatile, and they hold more weight when you're forming arguments as to what's going on in the market. Lower timeframes are going to be the opposite. These are going to be timeframes like the 1 hour, the 15-minute, the 5-minute. It's going to be less data in these, a lot more volatility, and they're going to be less solid arguments simply because the data is going to change so often. A final note on time. Remember that more recent data is always more valuable. Why is it more valuable? Well, when we're looking at the price data, the more recent price data is going to be a more accurate representation of the current market participants. Data from 1 year ago is going to be a lot more valuable than data from, say, 10 years ago. Why? Because, well, if I'm looking at what happened in the market a year ago, I think that's a lot more likely to be a good representation of the current market than what happened 10 years ago. It's as simple as that. Okay, so I'm quite excited for this. This is my visualization technique for analyzing chart patterns. It can help even advanced traders who never thought to look at the market like this. Before we get into it, I really want to make more free courses for you, but these take an immense amount of time and energy. To support me and get yourselves more free courses, all you have to do is use my link and make an account on Phoenix. That's all I'll say on it. Let's get right back into the video. Visualization technique. I always imagine there's a meter. On one end of the meter, we have a very bullish bias, which suggests that demand will exceed supply. What do I mean by this? For now, just think that that means price is going to go up. We're going to explain this in a lot more detail next lesson. A bearish bias means the data suggests supply will exceed demand. What does that mean? It means data suggests price is going to go down. That's the more technical description. Now, a bit of a fun one, which is helpful for new traders trying to get their grasp on what's going on. You can imagine a battle waging between buyers and sellers. The chart represents who's winning this battle. As I go through the examples, I'm going to explain this battle analogy in a bit more detail. If we look at the data over here, we can see that it suggests a bullish bias. In this example, I'm going to go a bit more into the battle analogy I was explaining. We've got two armies waging war. The bodies of the white candles represent the bull army. The bodies of the black candles represent the bear army. The chart represents the battlefield. Both armies are trying to get into each other's territory. Now, look at this chart and tell me who's winning the battle. Clearly, the bull army is winning the battle. Why is that? Well, look at these candle bodies. They're making huge moves into enemy territory. There was slight resistance here from the bear army, but the bull army continues to move up. And until they reach here, where there's a bit of a standstill. No one is able to break ground. The bears tried over here, but the bulls came back up. So in this analogy, another important thing is wicks. What do wicks represent? Wicks represent failed attempts to get into enemy territory. So when we see a wick, that shows strength for the opposing side. Here, bull candles going up, but big wicks coming down shows strength for the bears. That's the analogy. If you don't want to look at it as buyers and sellers, imagining that battle can really help people get an idea of what's going on. With that battle analogy, we can see bullish bias here and More recent data suggests a neutral bias. Where do we go on our bias meter? Over here. For the rest of this example, I want you guys to think context, sample size, quality, and keep it simple. You'll see exactly what I mean by that now. Now, guys, remember what I told you. Here we have a huge wick attempting to get into enemy territory and failing. Then we have a large body of bears breaking down here. So keep it simple. What does this candle represent? Large wick rejection and a new candle supporting bearish bias. Remember before, if we just go back here, our bias was over here. Now, our bias is going to probably move. So now that we have a simple analysis of the candle, the next step is to look at context. In the context of the previous data, how important is this candle? Well, in the context of the recent data, we can see that it is far larger than any of these. So no candle, no recent candle is anywhere close to as large as this. Why is that important? Well, it's more significant than any recent move. And what does the recent data represent? A far better example of the recent market participants. However, if we go back to, say, over here, we can see a much bigger candle relative to this. So this candle is less significant relative to this data, but more significant relative to this. So both of these need to be taken into account. For me, this is bearish. Recent data matters more than past data, and this rejection is quite large. So context, large body, and wick relative to recent data. Simple as that. Sample size, small. We only have one candle in this area supporting a shift to a bearish bias. So because of that, we're not going to jump to any quick conclusions. We're going to wait for more data. Quality. Now, quality is going to be the same for the most of this lesson. When it comes to quality, we're looking for anomalies. For example, if we see a completely out of place wick that comes down to here and then bounces back up to there, that's not going to be very reliable information. It's an anomaly, and we're not going to incorporate it into our analysis. If you remember, our previous bias was around here. Now we've moved to a very neutral bias because recent data is showing a lot of strength for bears, but we're taking into account that previously, because of this data, we were bullish. So next candle, what has happened? I'm sure most of you guys can figure it out. We have a second bearish candle, a huge body and a small rejection. This is supporting the bear argument. Keeping it simple, this candle here supports the bear argument. Now we bring in the most important thing, context. So in context, how important is this candle? Well, it's bigger than the previous one. It's bigger than any of these candles during this neutral period, and the bulls had a very, very pathetic attempt at reclaiming their ground. So our bearish bias will have significantly increased. Large body relative to the recent data, small wick relative to the recent data. That's how we do with context, just everything in context relative to recent data. Sample size. Now we have two candles, so we have a much stronger argument. Quality, remember, there's no anomalies here, and expect that for the rest of this lesson. So we've had a shift now. This candle is now, the sample size has increased to 2. This one is bigger than the last one, so we've moved very much over to having a bearish bias. And we have another candle. This one's a little bit different to the last two because it's smaller, so let's keep it simple. Third candle supporting bearish bias, but also shows a loss in strength. Now, where does that loss in strength come from? It's this wick over here. Why is this wick important? Well, if you look at this wick in context, you guys can see this wick is the same size as this body. So during this time period, bulls and bears have shown relatively equal strength. Though, if we bring in a little bit of a broader context, we can still see that we have 3 candles where prices move down. So the bears are winning without a doubt. Next, sample size. 2 candles in support of a bearish bias, and 1 candle in support of a more neutral but still bearish bias, because facts are facts, the bears have won, the price has moved down, even if bulls have managed to gain a little ground. So bias increases to the bear side, but stays relatively similar. What's happened next? Well, after our more neutral candle, we've had a bit of a neutral period where 5 candles have consolidated. No one is clearly winning the war. Keep it simple, bias unchanged, bulls barely able to regain lost ground. Bulls haven't really made any progress. The bias remains unchanged because the bulls haven't made any attempt to get back into bear territory. They haven't even gotten above the third candle. Context. More recent candles are insignificant compared to recent move. Look at the size of these, look at the size of these. Sample size. 5 neutral candles, nothing changes there. Quality, nothing looks like an anomaly to me. And bias remains relatively similar to previously. Next, we have another very bearish candle. This one, large body, definitely larger than the wick. Keeping it simple, bearish bias strengthened, wick noted. Context. Again, the candle size is significant, bigger than every candle here. The wick is also significant because it's bigger than any move made by the bull army here, or bigger than any of the other lower wicks on the previous candles. So I'm seeing some signs that the bears are losing strength, but without a doubt, this strengthens our bearish bias. Several candles are now supporting the bearish bias. There's only one wick showing strength in favor of the bulls, and that's this one there, and maybe you could argue this one over here. Quality, no anomalies, bearish bias has increased yet again. What happens next? Well, we saw a bit of strength again, and notice every time we've seen significant strength, we've seen a little bit of consolidation. This time, there was less strength relative to the body size than that one, and the price trailed down a bit and has been struggling to hold up. We can see some feeble attempts by the bulls to keep it up, and keep it simple, bias unchanged, bulls barely able to regain ground. Nothing that's happened in this period is significant because the sizes relative to these, our main bias forming candles, are very small, so we can ignore most of this. Context. Most recent candles are insignificant compared to the recent move. Next, sample size. 8 neutral candles, all supporting that bias, no real change in argument. Quality, also fine, no anomalies. So quality, no anomalies, and bias remains unchanged this time, because no candle here suggests we need to change our bias. As we can see, there's a further drop. So this is where we left off, and the price has continued to go down. This can confirm our bearish bias. Now that you guys have seen my strategy in action, how we have this bias meter that we keep changing depending on the picture the candles are painting, how we can visualize it as a battlefield in a war going on where wicks are failed attempts and bodies represent armies, we can, with a good understanding of that, master every single chart pattern. And I'm going to explain how. This candle here is a common pattern, which is shown in a lot of textbooks. We don't know what this is called, so we're going to try guess what this means using these 4 techniques. First, keep it simple. What can we see here? A large wick, disproportionately larger than the candle body. So it supports a bullish bias. Look, a huge win for the bulls and a tiny win on the body as well. So the bears got all the way down here, then they got pushed back. This is without a doubt a candle which shows strength for the bulls. Context. There is no context. This is a candle in isolation. I'd go to the point of saying this is meaningless. This could be in any context. This could be minuscule relative to the candles around it. It could be enormous. We don't know. Sample size, it's 1 candle. Quality. We also can't assess quality because we don't know if this is an anomaly or fits in data. This is why just memorizing candlestick patterns isn't very useful, because you don't know why a certain candle means a certain thing, which makes it impossible to use. So that candle was actually from this chart here. Now that we put it in context, it finally has meaning. So keep it simple. Large wick, disproportionately larger than a candle body. This candle supports a bullish bias, increased probability of reversal or end in downtrend. Now, we haven't quite spoken about trends yet, but assume that a reversal is a weakening or end of a bullish bias. and you can probably figure out what a downtrend is. It just means the price is going down. Again, don't worry if you don't fully understand that. We'll talk more about it in later lessons. So what's happened? Price has gone down, 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 and then bulls finally have a victory with this candle. Now compare this candle to this candle here. This one's much larger. This one's bigger relative to this candle and this candle, because that wick is larger than this and this candle. Not as big as this one, but bigger than the two most recent ones. Whereas this one is smaller than every preceding candle. Context. Larger than the majority of preceding candles, like I said, so this is strengthening the bull argument at least somewhat. Sample size, it's only one candle. One candle doesn't mean much. We'd want to see more candles before we take a significant strengthening of the bull side of the argument, but it's a strengthening argument nonetheless. Quality doesn't look like an anomaly. Nothing seems out of place to me. What happens after? Price has gone down, 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 and this signaled the stop, after which price consolidated with a slight trend to the upside. So here we can see 3 white candles and then 1 black candle coming down like this. Now, this candle, what does it mean and is it important? Keep it simple. This is a bearish candle, relatively large, engulfing the previous candles. So this one candle has engulfed this and this. One bear candle is cancelled out 2 bull candles. So the relative size is large. We do have a bit of context here, but not much. 1, 2, 3, 4. We have no idea what was happening before this. So again, we don't have much context. In isolation, this is not useful. Sample size, 4 candles. Next, no anomalies detected, but again, it's hard to detect anomalies on small data. Now, let's look at this pattern in a much broader context. Over here, I bet you guys can barely even spot it. It's over here. And now that we're in this context, keep it simple. Bearish candle, relatively small, makes no difference to our argument. I'd say this candle here and this candle here is far more important. We have on this small time frame suggestion that the price may go down a little bit. But when we take a bigger context into account, we think that the trend is generally still bullish. So context, immediate bias is bearish, big picture remains unchanged, and that is slightly bullish. Sample size stays the same, 4 candles supporting the previous argument, but we have 2 larger, more important candles, and arguably every candle which isn't smaller than these 2 supporting our bullish argument. Quality, no anomalies detected. Previous bullish candles are far more significant. And what happens after? Well, price goes down for a little bit. So this gave us an indication of what was going to happen in the immediate term. So relative to its sample size, then the bigger picture continued. Price went up, up, down a little, and up. So I hope you guys enjoyed this week's lesson. There's a lot to take away from it, and spend some time thinking about what you've learned. This is important for setting a foundation for what will become your analysis framework. You need to understand why you're using the charts you're using and what the data is representing. For homework, first and foremost, take notes on what you've learned. Take notes on anything which really agreed with you, anything you were easily able to wrap your head around and think you want to include in your framework. I want you guys to start gaining experience. This is something I'm going to ask you to do after almost every lesson. I want you to take a chart, and just like we did in the example, I want you to try paint the picture of what's happening in the battle. Who's winning, the bulls or the bears? Open a bias meter and start moving your bias across. Start learning how to interpret the data that's coming in. Look up chart patterns online. So this is going to be very useful. Without reading the description, get a chart pattern up and use your newly acquired skills to figure out what it's trying to represent. This will be a very useful exercise, and if you've understood what I've taught in this lesson, it's going to be very easy for you. And that's it for this lesson. I hope you guys enjoyed it. A special thanks to our sponsors, Femex. Remember, use my link below if you want me to make a lot of these tutorials teaching you everything you need to know about trading.